This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Corporate governance and auditor regulation. Corporate governance can be defined as the way in which companies are directed and controlled. Now, audit has a part to play in that because, of course, every year the company must publish its financial statements. The auditors do an independent examination of that, report to the shareholders. So at least once a year the shareholders should be confident of getting financial information which will tell them how the company has done and tell them how the directors have performed. But of course there can be over a year between one set of financial statements and the next, between one audit report and the next, and an awful lot can happen in a year. And of course there are unfortunately many cases of companies, even very large companies, going unexpectedly into liquidation, perhaps just through bad management, perhaps through bad luck, perhaps through fraud, and a system of corporate governance was essentially tightened, usually or mainly in the early 2000s, to try to ensure that companies didn't go too far off the rails before it was noticed. Now, the Organization of Economic Cooperation and Development, that's the OECD, that's a kind of global organization, has got some high-level principles that it would like to see applied to corporate governance. And what happens then is that different countries have their own ways of trying to realize these principles, to see that these principles are actually going to be working within their jurisdiction. So in the UK it is the Corporate Code, in America is the Sarbanes-Oxley Act and so on, and these are ways in which local countries have tried to implement this international OECD requirement. What the OECD wants to see from corporate governance is shown in this slide. First of all, they want a corporate governance system to promote transparent and efficient markets. That the corporate governance should promote, support effective supervision by the directors of the company, but also supervision of the directors and enforcement if rules are not abided by. An inefficient market would be one essentially where the share price didn't properly reflect the real value of the company, perhaps because the directors were issuing statements which were unduly optimistic, and therefore the share price would be much higher than it ought to have been. Obviously that is not transparent. It is not good for any type of market to have wrong values within it. Second, it should protect the right of shareholders. Shareholders, of course, own the company. Directors are the people who are day-to-day there running it, and we have this potential conflict between what the directors want to do, what they perceive as good for themselves, and what might it be actually good for the shareholders. In particular, it wants to ensure equitable treatment of all shareholders, including minority and foreign shareholders. So if you have a company which is listed on the UK Stock Exchange, there's perhaps a lot of rumours which go around in the City of London, but if you are an investor, say based in Sydney in Australia, you simply may not hear those rumours. You will be lagging behind in the information, and that will be unfair. Similarly, minority shareholders can be left out a little bit. If I ran a pension fund and I had 20% of a listed company, inevitably the directors, the finance directors, say, of a listed company, will try and keep on good terms with me because I've got a very powerful block of votes, and might be kind of telling me stuff or hinting me stuff as a 20% shareholder that a kind of 0.000001% shareholder simply wouldn't hear, and that again would be unfair. Stock markets should function properly. For example, insider trading should not be allowed, should be outlawed. Insider trading should be hunted down, if you like, should be detected if possible. There are rules and regulations about announcing when a takeover approach may have been made to you. So again, everyone is sharing the same information. Recognise the rights of stakeholders. Now, notice this here. We've been talking about shareholders a lot. But this is recognising the rights of stakeholders. Stakeholders do, of course, include shareholders, but also you have customers, you have, very importantly, employees, and so on. The idea that there should be some fairness to all stakeholders and the creation of wealth, the jobs and sustainability is not just to do with stakeholders who are shareholders, it is to do with all stakeholders. Timely and accurate disclosure should be made of all material matters. So if you were a pharmaceutical company and you discover that one of your blockbuster drugs has been making people ill and you have to withdraw it from the market, that's going to be a great hole in your revenue, then you ought to come clean with that. You ought to announce that to everyone as soon as you know. Otherwise the shares are going to be misvalued on the stock exchange, people are being misled, people may buy into these very high price shares only for the next day then going to collapse because of information which was held back by the directors. And then there should be strategic guidance of the company. Strategic guidance means long term. We're not just talking about what profits can they make this year. When you see the word strategic, think about kind of 5 years hence. What are the directors doing to ensure that this company will be surviving and thriving in 5 years' time? How do we monitor management? How do we monitor directors? How is the board made accountable? Because they're at the top of the pyramid. And if they're not held accountable, if, for example, their performance is not reviewed, then how are we going to ensure that everything below them is operating properly? Now, the UK Corporate Governance Code is the way in the UK the OECD principles are kind of realised. For the sake of the exam which you are doing, you can regard the UK Corporate Governance Code as best practice, if you like, or certainly good practice. And you're allowed to talk about what it suggests as ways of implementing the OECD requirements. In the UK, it is what's known as a comply or explain approach. In other words, there is no law, no statute which tells companies this is what you must do. The only companies to which any pressure can really be brought are listed companies listed on the stock exchange, because the stock exchange expects these companies to comply with these provisions in the Corporate Governance Code, or if they don't, have a very good explanation why they're departing from them. And the ultimate sanction of the stock exchange would be to suspend the listing of the company's shares so they could be no longer traded. If you have unlisted companies, there really is no sanction at all, other than perhaps criticism and people being a bit suspicious of them, but there's no real sanction that will make them comply with the UK Corporate Governance Code. Again, in the UK, we have got a principles-based approach. Companies are supposed to follow certain principles. The thing about principles is they can be adaptable to different situations. In America, by contrast, they implemented through the Sarbanes-Oxley Act that is very much a procedural approach. There's really a list of kind of requirements that have to be signed off, very often both by the directors and the auditor. Yes, the company's done this, yes, the company has done that, and so on. It's much more straitjacketed in a way, and it's actually quite expensive to ensure that enough work has been done, that people are willing to sign that off, because there are very severe sanctions if you sign off something on Sarbanes-Oxley and it turns out not to have been right. In the UK, the main principles, these ones here: leadership, division of responsibilities, composition, succession, evaluation, audit risk, internal control, and remuneration. We'll just look at each of these in turn briefly. First of all, leadership. The effective board is collectively responsible for the long term, again getting down to that strategy, the long-term success of the company. Collective means the board has to meet. It is not going to be an effective board. It's not going to have collective responsibility if you have a CEO who goes to one director and kind of gets that person on their side, and another director has a little side-to-side conversation there. So when they come to the board meeting, everything's kind of been agreed. It has to be collective responsibility for the long-term success. Directors should act with integrity, or if you like, honesty. It means a little bit more than honesty. The directors should stand up for what they believe in. The directors should refuse to do something which they believe is wrong. The board should establish the purpose, values and strategy of the company, ensure that the required resources are available, really to put the strategy into effect, that they should identify and manage risk and put controls in place. So, for example, in a jewellery company, one of the big risks is inventory, of course, because you've got small, high-valued items. They have to identify that as a key risk, and then they have to put controls in place, which is going to substantially control the inventory loss. There should be effective engagement with shareholders. An interesting one. What in fact is probably still the case is that many shareholders take nothing to do with the company in which they've invested, particularly small shareholders. So the annual financial statements come through the post, and many shareholders may not even open them, or if they do, they just look at what the dividend is. And to some extent, shareholders were their own worst enemy. They didn't actively engage with the board. They didn't attend the AGMs. Now, it's up to the board to try and encourage a good two-way flow of information and communication, and certainly the idea of an activist investor, somebody who will go to an AGM and actually ask awkward questions, actually maybe vote against the suggested director's remuneration and so on, is at last becoming a little bit more common. And ensure workplace policies consistent with values and which will support long-term success. For example, it might be certain policies which are there to do with equal opportunities, or certain policies which are there to ensure that raw materials are only sourced from ethical supplies and so on there. If the board thinks this is important to long-term success, then we have to ensure that this wish, if you like, is translated into policies. Division of responsibilities. One of the problems discovered with some of these companies that went into liquidation was that you had at the top a very powerful, charismatic, perhaps almost bullying chief executive officer who had almost 100% power. Now the corporate governance codes, there should be a clear division. They split at the top between running the board and executive responsibility, in other words, running the board and running the company. Therefore, the roles of the chief executive officer and the chairman should be split. The chairman runs the board, the CEO runs the company, and this should stop. For example, the CEO deciding what should be discussed at the board meeting. Now the chairman will decide what's going to be discussed at the board meeting. The chairman will ensure that every single board member is heard and their views are taken into account. Chairman, as I've said, responsible for the leadership of the board. No chairman should be in post for longer than 9 years. But there should also be non-executive directors. Non-executive directors sit on the board, have got full voting rights in the board, but they have got no day-to-day responsibilities. Therefore, the idea is they can come and they can give advice and they can monitor, they can watch, they can warn, and then they can vote. And because, in particular, their remuneration is not in any way linked to profit, they should be perhaps more objective. The executive directors might want to take a bit of a risk on a particular project, because if it does well, their pay goes up. But of course, risk might not always be good for, or too much risk might always be good for the shareholders. And the non-executive directors should be there to challenge and to question whether that risk is really what the shareholders would want the board to decide on. There should be, in composition, succession and evaluation, a formal and rigorous and transparent procedure for appointing new directors. What you don't want is for a vacancy to come up on the board and then the CEO to say, I have a friend who could do that. And why would you do that? Why, when you are appointing other people, do you advertise the post, get in CVs, interview people, give the job to the most suitable candidate? You have to do that to the board as well. These people are of key importance to the long-term success of the company. This has to be done by a nomination committee, and the nomination committee is comprised of non-executive directors. The board needs an appropriate balance of skills, experience, independence and knowledge. But we should regularly look at the board. Obviously the company's changing, and obviously the directors may get old, stale, bored and so on. We should continually make sure that we have a board which is fit for purpose, really. The board should undertake a formal and rigorous annual evaluation of its own performance and that of its committees and individual directors. Again, it is common in companies for everybody at every layer to have a review by their manager. But what was happening was you had the board at the top who maybe made a complete mess of launch of a product, a takeover of a company, some sort of PR disaster, and yet they were never reviewed. Nobody ever said to the finance director, how come we run out of cash? Didn't you do a cash flow forecast and arrange with the bank in plenty of time to get a larger overdraft? And all directors should submit themselves annually for re-election. Audit risk and internal controls here. It is important that there are formal and transparent policies and procedures to ensure the independence of both the internal and the external auditor, and therefore the integrity of the financial statements. Obviously the external auditor is probably independent. The external auditors have their own rules about how they can be involved with a company. The perhaps tricky one here was the internal auditors, who are employees of the company, who may be beholden in some way to the finance director for their job and their promotion. The board should present a balanced, understandable assessment of the company's position and prospects, and in particular the board is required to look at the going concern position of the company. Will it survive the next 12 months? And this has to be stated, if you like, as a note in the financial statements that they have indeed looked at this 12-month future, and yes, they think the company should be surviving at the end of that time. They have to manage risk. Manage risk means some way of identifying risk, sometimes some way of trying to quantify risk, some way of saying, well, with that risk I don't want to go there, I don't want it at all, or with that risk maybe I'll try and insure against it, and so on. We need to bring in internal controls to manage risk and to make sure that the assets of the company are safeguarded. There should be, therefore, an audit committee. An audit committee is composed of non-executive directors, and the audit committee will, it will look after, for example, the internal auditors and the external relations with the external auditors. Again, it used to be that the external auditors would liaise with the finance director, but the finance director was maybe the person responsible for the internal control, and maybe the internal control wasn't very good. So the auditors, or even internal auditors, reporting to the finance director, the person responsible for internal control, that internal control wasn't very good, and you had this kind of circular system going on. Now complaints, if you like, criticisms are made to the audit committee, and these non-executive directors, being full board members, can bring serious points up at the board meeting, rather than allowing the finance director to perhaps suppress something which is a bit embarrassing. Remuneration. We're not looking for the cheapest possible director. They might be useless. We're looking at remuneration which is sufficient to attract directors of the right quality. Remuneration should line up with strategy. And one of the best ways of doing this is to link a substantial part of directors' remuneration with corporate performance. So a typical way of doing this is to offer directors share options. So you say part of your remuneration is going to be, we will offer you at the end of the year share options which allow you to buy, maybe in 5 years' time, shares at $10 each. So 5 years' time, sets a long-term strategy. It makes the directors focus on 10 years, and you'll only buy the shares at $10 each in 5 years' time if the shares are above $10. And of course the shareholders are going to be really pleased if the shares go way up above $10. And the directors are going to be really pleased because their options will be worth a lot of money if the shares go up above $10, where they can still buy at 10. It's important, however, that if the company doesn't do well, that the directors do not still get this high remuneration. It has to be realistically moving, if you like, with the company's prospects. Again, what we don't want is we don't want directors to be deciding on their own pay. So again, we have the third committee. We've had the nomination committee, the audit committee. Now we have the remuneration committee, composed of non-executive directors, and this is what is responsible. The committee is responsible for deciding the amount of pay and the calculations involved in pay, the shape of the pay, which is going to individual directors. Here we have what the audit committee does. We've mentioned the audit committee. First of all, it liaises with the external auditors. It will define the scope of the external audit. It acts as a forum, a link between the directors and the auditors. So if the auditors are perhaps worried about something or can't get some information, or maybe want to make some sort of a complaint to the directors, this will usually go first to the audit committee, who can then kind of bring it up in the board meeting and try and get it resolved. So dealing with auditors' reservations. The auditors think that some amount in the financial statements means they don't show a true and fair view. Then they would talk to the Audit Committee. The Audit Committee can then talk to the Finance Director and the Board, maybe to talk about altering that amount in the financial statements. If someone, maybe the Finance Director, seems to be withholding information or concealing information, again, this can be brought up to these non-executive directors. Remember that the Finance Director is not playing ball, that we need this information and we're not getting it. It'll review the independence and objectivity of the auditors. Are they, for example, big enough to deal with us? So you have your auditors, you have the client gets bigger, 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 bigger. Maybe at some point you feel that the small firm of auditors is not actually up to dealing with this large, perhaps now international company, and maybe we should think about changing to a bigger firm of auditors. And finally, to approve non-audit services, like maybe asking the auditors to investigate a fraud or to review maybe IT security or something of that type. They also review internal audit. They should be reviewing the system of internal control. The board has responsibility for internal control, but generally speaking, the review of that will be carried out by internal audit, and the internal audit reports are likely then to be in their turn reviewed by the Audit Committee. And they're also responsible for monitoring the integrity of the financial statements. There should be someone with financial knowledge on the Audit Committee who should be able to look at the kind of technical matters in these financial statements. The regulatory environment. There are a number of levels of regulation. First, we have self-regulation. So ACCA regulates its members. And what happens is that in the UK, the government, in a way, delegates auditing responsibilities to accountancy bodies like ACCA, who then look after ensuring that members of ACCA have the right qualifications and training, that they behave ethically, and that they follow, for example, the auditing standards to make sure that audits are conducted correctly. Then we have national bodies, and in the UK, the FRC, the Financial Reporting Council, regulates corporate governance. It issues the UK Corporate Governance Code and also regulates the accountants and auditors. It is, for example, the body which is responsible for agreeing to adopt international financial reporting standards. Then we have international level, we have the International Federation of Accountants, and then finally we have something called the Public Interest Oversight Board, which we'll see right at the end of the lecture. International Federation of Accountants, its purpose is to serve the public interest and to strengthen worldwide the accountancy profession, establishing and promoting adherence to high quality professional standards, and actually getting a kind of uniformity throughout the world of these standards. So that if someone follows IFAC, then you know that the audit that they perform should be to a kind of international standard rather than just a local standard. Within IFAC, we have a number of committees. There's the IAASB, the International Auditing and Assurance Standard Board. This issues international standards in auditing and other assurance standards, which then typically are taken on board by each country's regulators. There is the International Ethics Standard Board for Accountants, the ISBA. This issues the IFAC Code of Ethics, and, for example, the ACCA Code of Ethics. It is essentially this international Code of Ethics simply adopted by ACCA. And then we have the TAC, the Transnational Auditors Committee, and this basically looks at the international dimension of audits. That can be sometimes maybe you can imagine, for example, maybe difficulties. You have a holding company in one country, a subsidiary in another country. Maybe they're making up accounts to slightly different standards. Maybe there's a problem in remitting information of the right sort up to the holding company for the audit of the group financial statements and so on. And this tries to, I suppose, iron out certain international problems. Public interest oversight boards. Now, I suppose to some extent the problem with all the oversight levels we've seen so far, ACCA, the FRC, the IFAC, they're all very accountant-centric, really. Kind of, for accountants by accountants. And what the Public Interest Oversight Board does is try to broaden that slightly and say, well, it's not just accountants using accounts. So there are banks, there are stockbrokers, there are insurance companies, there are pension funds and so on. These are really public interest sort of responsibilities, and we want to make sure that the regulation of accountants and auditors appropriately reflects their responsibilities to the public interest. And the PIOB tries to bring greater transparency and integrity to the audit profession to make sure that it serves the public interest, not just the interest of accountants. It has oversight of the IAASB and other public interest IFAC committees, as I say, to try to make sure that the regulation of accountants serves a very wide constituency of users of the financial statements.